Hey guys, welcome back to my channel. In today's video, I wanted to talk about how much of your paycheck you should save. Now, if you've ever found yourself wondering about this question, I just wanted to let you know that you're not alone. According to data just presented last year from Payments and Lending Club, nearly 65% of all Americans are currently scraping by, living paycheck to paycheck, shown in this white line here. And even worse, just over 50% of Americans who make over $100,000 a year are also living paycheck to paycheck, as presented by this blue line. Now, it's no wonder that people aren't putting their savings on the top of their to-do list. And personally, I think it's fair to agree that saving is crucial, of course, but the million-dollar question still is, how much should we really all be saving? Well, it all boils down to our unique spending habits. Everyone's a little bit different when it comes to handling their money, and don't forget that just because one person may have more cash than someone else, that doesn't automatically mean that they will save more or vice versa. So, I want you to sit back, relax, and get ready, because today I'm cracking the code on how much of your paycheck you should consider putting into your savings. In addition to that, I've also got some helpful tips to help you ramp up on those savings even more. So, without further ado, let's go ahead and start. I'm going to go ahead and begin with step one, which is, how much of my paycheck should I save? Well, you've likely heard the expert advice coming around that says you should save at least 20% of your paycheck every month. And honestly, it's a solid target if that savings aligns with your goals. But this isn't a one-size-fits-all scenario. Aiming for that 20% is a smart move if it fits into your savings plan. However, your financial journey is your own, and sometimes that 20% might need a little bit of tweaking based on where you currently stand and what aligns with your budget. There will be times when achieving that 20% mark is a struggle, and other times when life might prompt you to save a bit more or ease up. So before I get into the nitty-gritty of this theory, I'm going to tackle another savings rule that is often considered as the best of the lot. And this is known as the 50-30-20% rule. This 50-30-20 rule is a budgeting approach that splits your cash into three different parts. 50% is for needs like groceries, housing, utilities, health insurance, and your car payment. 30% is for your wants and discretionary spending like shopping, dining out, and hobbies. And then the remaining 20% is for savings, and that could be whatever you may choose, like putting it into a bank, investing it, etc. This rule has its fair share of positives, and it's typically a good trend to follow. But there are some drawbacks that often get overlooked. This rule sticks to those fixed percentages no matter where you are at in life or what your financial situation is looking like. Of course, in some cases that might be too rigid of a plan to follow. For example, just imagine a situation where you're deep in debt and this rule insists on you throwing 30% of your income at your wants. That's obviously a bit crazy. Also, for 20% savings, that generally covers everything from your emergency funds to paying down debts above the minimum amount, saving for big purchases or investments, and even your future retirement account into one tight 20% bracket. To be honest, it's not really practical to afford all of that with a 20% minimum of your paycheck. So this leads me to ask, what are your savings goals? We've really got to be clear about what the purpose of your savings truly is. Just saying, I want to save money won't be enough. The goal is aiming for precision here. How I made this work for me is that I took time to figure out what exactly I was saving for. In my case, I wanted to buy a house, so I followed the strategy that I wouldn't dine out, party, go on vacation, or spend money loosely. Most importantly, I stayed incredibly disciplined to hit that goal. For several years, I would stick to this plan just to make sure that I could buy a house one day, and sure enough, I was able to. So my recommendation is to make sure that the goal you have is measurable, you set a deadline towards it, and most importantly, you make sure that they are your goals and not something that your friends or family told you to aim for. There's actually this great quote by this lady named Rita Mae Brown, and she said, "If it weren't for the last minute, nothing would get done." And that just highlights the fact that without you placing a deadline on your goals, you'll never actually get to your goal. It kind of reminds me of the time that I was in school and we had due dates on assignment, and I would wait till the very end to actually start working or completing the assignment. So that's why this is important. setting a deadline can actually make you achieve your goals accordingly. And then only after your goals are clear, you set a deadline, and then you remain consistent and disciplined, will you be able to make your money hustle in the right direction. So now step 2 begs the question, how much should I actually save in step 1? So let's go ahead and run the numbers. I would personally recommend that you do anything and everything you can just to save up $1,000 from your paycheck. And I mean it, guys, nothing more than $1,000 and nothing less than $1,000. Forget about saving $5,000 or even $200. I'm simply saying to set the first goal of saving a solid $1,000. Now you might ask, why is this important? Because at the very least, it's an achievable goal that no matter how difficult it may be to get there, you can actually make it happen. It will provide enough cushion to sustain for potential emergencies or paying down debts. But most importantly, it will teach you the right mindset of cutting back on discretionary spending. Though it might feel hard at first to not buy an extra pair of brand new shoes, that coffee from Starbucks, or let's say your Netflix subscription, it will teach you the frugal mindset of achieving your goal and doing whatever it takes to make sure that you get there. Now, according to a recent research article shown on NerdWallet, less than 45% of Americans would be able to cover a $1,000 emergency expense without turning to a credit card or loan. Now, to me, it's insane to think that less than 45% of Americans have less than $1,000 even saved for emergencies. That's a position where none of us would like to be. So if you are getting paid bi-weekly, saving $500 from each paycheck, taking you a month to reach that $1,000 goal is a nice goal to discipline yourself to get to, and I want you to try to do everything you can to get there. If this plan is too tight, don't stress. Just attempt to get creative and cut back or sell some stuff to speed things up. Before you know it, you'll have $1,000 saved, and right there, you will have achieved the first goal of saving $1,000. Now, before I dive into step 3 and what you should do with your savings, if you really found this video helpful so far, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support definitely helps this channel grow, and I'm all about providing free and helpful content without charging for a course or anything like that. I also have opened up my YouTube memberships on my channel, so if you are interested in signing up for more financial assistance, feel free to do so. So let's go ahead and get into step 3. What should I do with the $1,000 that I save every month? Well, my personal recommendation is that you do the following to better your financial career. First, I would consider putting that money into a high-yield savings account. This way, your money isn't just sitting in the bank and collecting dust. A high-yield savings account can generally provide you a return of 3 to 5% interest on your money invested, and you can remove it anytime you need to without fees or penalties, depending on the brokerage that you work with. The second route you can go is to tackle consumer debts, especially those with high-interest student loans or credit cards. Now, once you start chipping away at paying more than the minimum, you will reduce the overall amount until it's eventually completely cleared. And you can begin at step 1 again, where you are now saving that money. The last thing I would recommend is that if you aren't trying to go with the first or second option that I provided, then I would ask that you just invest that money in yourself. Try to enhance your skills, your knowledge, or even your social abilities. Buying books or taking courses can yield long-term benefits in making more money. For example, you could consider starting a business. Even with $1,000, a side hustle can lead to substantial returns if you manage it wisely and you stay lean on your expenses. You could check out my video where I explain 9 different unique side hustles to make money to get some pretty good ideas. And last but not least, step 4, where to store my savings. In this final section, I wanted to expand for you investors that maybe have an easier time saving $1,000 a month but aren't totally sure what to do with it if the side hustles aren't really your style. So as I mentioned in step 3, high-yield savings accounts are probably your first greatest option. A high-yield savings account falls under a special category backed by the FDIC protection to generate you some passive income without you physically having to do anything for it. They generally offer higher interest rates compared to your standard bank savings account. This is primarily due to high-yield savings accounts cutting out the middleman of an actual brick-and-mortar bank location and using that saved money to then pay its investors for putting their money into that savings account. Every brokerage has their own set standard rate of your earnings based on who you want to go with, but it's free money nonetheless. In most cases, you'll need to have a heftier deposit amount just to see some legitimate gains, but the increased earnings make it worth considering a larger initial investment. You may also want to consider reaching out to your primary bank, and you'll notice that some may actually extend this perk to their loyal customers who have had accounts with them for a while. The next option to invest your money is under certificates of deposit. This is otherwise known as a CD. CDs are a financial option offered by many banks and credit unions. You could think of them like a savings account, but more of a contract agreement between you and your lender. CDs usually dish out higher interest rates, especially if you are playing with larger sums of money or committing for the long haul. In this scenario, you agree to deposit your money into the CD for a set period of time. The lender will then lock in an interest rate, and you won't really be able to touch that money again until your contract agreement terms are over. If you try to bail earlier than what your agreed contract is, then you might face some penalties like losing a chunk of your hard-earned interest. CDs typically have maturity periods ranging from 6 months to as late as 5 years, depending on what you sign up for. Eventually, when it does mature, you can either cash it all in or roll it over with any earned interest thrown into the mix as well. And the last investment strategy that I can offer is investing in mutual funds. A money market mutual fund is like the superhero of low-risk investments. It's a type of mutual fund that dives exclusively into low-risk securities, making it one of the safest options out there. These funds aim to match the returns that you would get from short-term interest rates. You can snag them through mutual funds, brokerage firms, and plenty of banks. Now, even though they are generally low risk, the interest rates may fluctuate as they're not really set in stone. They can be a bit elusive as well. So, a little research will honestly go a long way. Look for a money market mutual fund with a track record of solid performance to give your investment choice a nice confidence boost. And that's it, guys. These are my recommendations on your paycheck savings journey. From understanding the 20% rule to mastering the art of step-by-step money saving, you're now equipped to transform your financial game. Whether it's just the emergency fund hustle or diving into investments, remember your unique financial journey may be different than others, but simple steps can help you get miles ahead in the long run. If you found this video helpful, please go ahead and share it with anyone who might be interested in incorporating some of these lessons in their life. If you have your own financial experiences or suggestions, don't hesitate to share them in the comments below. And of course, don't forget to hit that like button, subscribe, and ring the notification bell for more videos every week. I want to thank you all for watching, and I'll catch you all in the next video.